The economy just screamed, and we're all pretending we didn't hear it. The yield curve, it's not inverted. It's dying on the floor, screaming for help. And if you think this is like 2008, sweetheart, 2008 was a paper cut. This is the economy getting hit by a tsunami made of debt and Zoom calls from your cousin who bought crypto in 2021. Let's get one thing straight. You don't need a finance degree to understand this. Imagine you're at a bake sale. Short-term bonds? That's your $5 cupcake. Long-term bonds? That's the $50 wedding cake. That's supposed to last 10 years. Normally the cake costs more than the cupcake. But right now, people are paying more for the cupcake and refusing to touch the cake. Why? Because they think the cake is going to be expired. And the cupcake, it's got sprinkles and hope and 37% more sugar. That's an inversion. And historically, when the cupcake costs more than the cake, the whole damn bake sale collapses. Let's compare. In 1929, the U.S. national debt was $16 billion. In 2008, $10 trillion. And today, $34 trillion. That's not a number. That's a Netflix documentary called How We Borrowed Our Grandkids' Future. And guess what? The inversion in 1929 lasted 3 months. In 2008, 6 months. Right now, it's been inverted for over 2 years. And let me tell you, that's longer than your last relationship. And it's deeper than your ex's excuses. The spread between 10-year and 2-year treasuries, it's at its worst level since the Civil War. And here's the kicker. The Fed's been lying to us. They say, we're cooling inflation. Meanwhile, your gas bill, still $70. Your rent, up 40%. Your Netflix password, shared with 7 people. And your 401k, still in crypto, because your Uncle Jeff said it's the future. The economy looks strong. It's wearing a tuxedo while standing on a pile of expired credit cards. Here's the scary part. The economy looks fine. Unemployment, low. Stock market, all-time highs. Elon Musk, still posting memes about Mars. But here's what they're not showing you. Corporate debt is at record level. Companies are borrowing money just to pay interest on their old debt. It's like you're taking out a second mortgage to pay your first mortgage. And then you say, I'm financially responsible. Consumer debt, $17 trillion. That's more than the entire GDP of Japan. Government debt, $34 trillion. That's more than the combined GDP of China, Germany, and India. And we're still throwing parties? We're not in a bull market. We're in a fake-it-till-you-make-it simulation, where the AI running the game just crashed. And the screen says, you have 3 days before the economy runs out of Wi-Fi. You think this is bad? Let's talk about 1973. The yield curve inverted. Then recession hit in 8 months. Inflation 12%, unemployment 9%, gas prices so high, people started riding horses. And guess what? The market didn't crash slowly. It fell off a cliff. In 1973, the S&P 500 dropped 48% in 2 years. In 2025, we got inflation, debt, AI job loss, supply chain chaos plus political gridlock. That's not a perfect storm. That's a hurricane made of tornadoes riding a dragon with a credit card in its mouth. And the Fed, they're still saying we're good. Meanwhile, they've got more debt than a college grad with a degree in how to be an influencer. Okay, panic, not helpful, but preparation? That's the difference between losing your house and keeping your sanity. Here's what you do right now. No fluff, no crypto hype, just real move. Dump the must-have stocks. If your portfolio is 70% tech stocks and 30% hope, you're not investing, you're gambling. Sell the hype, buy the essentials. Think utilities, healthcare, consumer staples. Companies that sell toilet paper, not NFTs, a monkey in a spacesuit. Build a 12-month cash buffer. Cash isn't dead. It's the VIP pass to the next economic party. If you have 3 to 6 months of expenses in cash, you're golden. If you have 12, you're the hero of your family group chat. Avoid long-term lock-in debts. Don't lock into a 30-year mortgage if you think the world's going to end in 5. Refinance, maybe, but don't take on new debt thinking you'll be fine. It won't be fine. Your credit score won't save you when the economy crashes. Learn to spot the signs before it's too late. Bookmark this. 10-year treasury yield below 2-year. Red flag. Corporate bond spreads widening. Red flag. Layoffs in tech, retail, and finance. Red flag. Don't wait for CNBC to say recession. By then it's too late. I know it's easy to ignore this. We've been told markets always recover. But this time, the recovery isn't just delayed. It's being delayed by debt. And debt doesn't care about your TikTok trend. It doesn't care if you posted a "I'm financially free" video with a $2,000 iPhone. Debt just waits. And when it strikes, it doesn't knock. It breaks down the door. And the people who thought this time is different, they're the ones crying in the parking lot, while their neighbor, who kept cash on the mattress, is buying groceries and laughing. You can keep scrolling. You can keep buying Tesla stock because Elon said so. Or you can hit like, subscribe, and comment below. I'm keeping cash. Or I'm doubling down on crypto. And let's see who's actually prepared. Because when the crash comes, the people who laughed won't be laughing anymore. And the people who prepared will be eating chips in peace.